In this video, we dissect the mechanics of price formation, the bid, the ask, and the spread. Every financial asset displays two prices simultaneously, not just one value. The bid represents the highest price a buyer is currently willing to pay. Effectively, this is the price at which you can sell your option immediately to the market. Conversely, the ask is the lowest price a seller is willing to accept, marking the price you must pay to enter the trade instantly. Understanding this duality is critical because you never buy and sell at the exact same price point. The gap between these two figures is known as the bid-ask spread. This spread functions as the immediate cost of doing business, effectively compensating the market maker for providing liquidity and taking on risk. When you execute a market order, you are paying this spread, meaning you enter the trade at a slight disadvantage. The asset must move in your favor enough to cover this gap before you can theoretically exit at break-even. We utilize the spread as our primary gauge of an option's liquidity. Highly liquid options, such as those on major indices like SPY, typically exhibit tight spreads, often just a penny wide, which minimizes your slippage costs. In contrast, illiquid options display wide chasms between the bid and ask, creating significant friction that can erode a large percentage of potential profit upon entry and exit. Let's contextualize the financial impact of wide spreads with a practical example. If an option has a bid of $2 and an ask of $2.50, buying at the market costs you $250 per contract, but the position's immediate liquidation value is only $200. You are instantly down $50 or 20%, simply due to the liquidity friction. This mathematical disadvantage highlights why avoiding illiquid chains is paramount for long-term survival. Experienced traders rarely execute market orders at the hard-ask price unless speed is the only priority. Instead, we utilize limit orders to target the mid-price, which is the theoretical fair value located halfway between the bid and ask. By working the order, placing a limit at the midpoint and slowly adjusting, you can often get filled inside the spread, significantly reducing your cost basis and improving your probability of profit. As a general rule for the strategies we will discuss in later phases, you should exercise caution when the spread exceeds 10% of the option's total value. Wide spreads act as a tax on your statistical edge, requiring larger directional moves just to overcome the entry friction. Always check the width before execution. It is a vital component of risk management that separates professionals from gamblers. Join us in the next episode as we explore volume and open interest.